Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, or financial topics. So we're going to dive right in there, take a look, see what people are sharing. If you want to follow me, it's at finance. And if you want to join our community, finding-value.com, that's where I dive deeper into all of these topics, sharing my opinions on what I think looks good for this commodity bull market in terms of individual companies. Coming down to Logan, he says loan to value ratio for US mortgages and outstanding mortgages. And look at that thing fall. So the value is going up and the loan portion of it is going down. And that obviously can occur with the house prices going on up. I know my loan to value ratio has definitely come way down from where I purchased it over the years. So I could easily believe this chart. And right now it's under 50%, which means the loan is less than 50% of the value of the house. That is what it's saying. So, in my opinion, a lot of people are going to have to go through a lot of, I'll say, stress before a foreclosure occurs. Foreclosures are easy to happen if you have no money down. You can just say, you know what, I'll walk away from the house. But if your loan to value ratio for a US mortgage is below 50%, that means you're walking away from hundreds of thousands of dollars. And I don't think people are going to do that. I think they'd sell the house or figure out ways to keep it if you got a loan to value way down here. But for the majority of people. Coming down to the Headless Horseman, it says, who's ready? Revenge of the gold miners. So this is homestake mining in the Great Depression. And the one thing that I will say is that commodity bull market was a little bit different. Um, they were in a depression or they were slowing down in terms of inflation, and they revalued basically commodities with gold. They revalued it 50% higher, the gold price. And obviously, the gold mining companies went ballistic because you just increased what they sell 50%, and their inputs are deflationary. They're going down. So great time to be a mining company during that time frame. Uh, October 29 to July 1932 in this range here, the Dow Jones was down 90%. Homestake was up 105%. And obviously that ratio went from being way under the Dow Jones to being way over the Dow Jones. So that ratio means that you could purchase far more Dow Jones Industrial Average if you had owned Homestake Mining. Silverbank, it says gold to silver ratio approaching 90 to 1. Just keep the sanity, full breakage of multi-decade Ponzi within sight. And I think this is the slowdown that's driving the gold to silver ratio back upwards. The slowdown or the threat of a potential slowdown uh, is scaring people towards gold in the short term. I do think here shortly this is going to reverse and silver is going to vastly outperform gold. All of the chart patterns are suggesting a big move in silver and gold, and I think silver is going to rip. But in the short term, if there is a slowdown and people are moving money around, everything could get sold off. And I know silver is a little bit more volatile than gold, and we could see this ratio continue upward for a short period of time. Much like 2020 here, where we broke out and then came back lower, I think we're doing something very similar to that, where we're going to come up and then break on down. Here's the S&P 500. The S&P 500 advancing declining issues indicator is not oversold, and that's on the bottom here. Obviously, you can see we squeezed up into these rising wedges and then rolled on over in 2021, 22, and we've got a similar pattern that has shaped up like this last one just recently. And we're not at oversold levels, so we have a long way to fall before we get to oversold levels, at least on that moving average exponential that he's got at the bottom there. Here is me. So we got GDX, which is the gold miners, versus XOP, the energy exploration, and COPX, which is copper miners. Here's the downtrend line that we've got as support, a breakout, a retest, and now we're moving higher for GDX to outperform XOP. And this, if you were to chart it, just looks like the unemployment rate. That's what it looks like. And then here's GDX versus COPX, and we're right at resistance here where we could potentially break out, where the gold and silver mining companies could outperform the copper companies. That would definitely occur during a slowdown. That also occurred here in 2018 when the yield curve uninverted here. It peaked in 2020 and then reversed lower. So I think this follows the slowdowns in the economy, and GDX outperforms during those slowdowns. Trailing stop loss. So this is stage analysis investor method. So we have a stage 2A breakout, enter the trade here off a double bottom, basically. First base, second base, third base, and then a peak. It says fourth and fifth bases within the stage 2 advance are more prone to failure, so watch for warning signs. According to this, they've got the initial stop loss here, and then they say raise the stop loss on move back towards the high following each significant pullback. So you move it towards the high here as you come on up, and then move it on up. In all honesty, I've tried using stop losses, and they're just really annoying to me. Maybe I put the stop loss too tight. That is where you basically get kicked out at the lows every time. So I don't use stop losses. I use my position size to control my risk. And as long as the tailwinds are pushing this up, 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 and up, I'm going to ride it all the way up. And maybe I'll sell it as it comes back down anyway, which would be probably pretty similar spot to where the stop loss is anyway. So that's how I would do it. And I don't use stop losses because every time you use a stop loss, I probably put it too tight and I get kicked out. And it's usually too early that I get kicked out. He says that this person says, important, don't raise your stop loss until the price moves back near to the prior swing high of the most recent advance. The stop loss should remain below the rising 30-week moving average and each significant weekly swing low throughout the majority of stage 2 advance in order to give it enough room for its natural gyrations when consolidating after each advance. Get more aggressive with your stop loss placement when you begin to see signs of stage 3 developing. Yeah, I don't really use this, but that's how they use it. Whoa. Coming down, your entire trading career is contained on the underlying word below. This word means more than $10,000 course. All right, let's see what it says. It says if a stock gets very shaky for even a single day, I'm out. I would trust no stock blindly ever again. And I knew that anything I might read during the market day is intended to mislead me from the winning side of the trade. I never believed in a stock story or a rumor or a news report ever again. Everything I need to know is based on the stock's price behavior and volume. The rest is pure noise. That's coming from a trader, like an investment trading. I'm not a trader. I do believe that you can look at cycles. I do believe that there are fundamental differences between companies. I do think that there are times to be invested in certain assets, and there's other times where you don't want to be invested in those assets. So it's not about using news or what you read during the market day. None of that really matters, in my opinion. The technicals are there. They're there to aid you in finding positions, like taking a position and finding when to enter. I think the technical analysis is really good, but I don't rely on it completely. If you don't know when certain assets do well, I don't think the technicals are strong enough or strong enough returns. So I think you need to combine it with something else. And that's where ratios come into play. That's where you can find where the cheap valuations are at. And then the market conditions and cycles. Where should I be looking? Where is the puck heading? Not reading in the rearview mirror of the herd putting down price, movements and trying to project forward. I find it incredibly difficult to only read the tape and not know anything about the company and know nothing about the sector and know nothing about the market conditions. Your success rate goes way down by just reading the tape and not knowing what it is and during the certain market condition. Um, some things that would improve my percentages would be, where's the yield curve at? What are yields actively doing? Are they going up or are they going down? A couple of questions like those. And if you knew what the market conditions were, I could probably tell you what's going to do well and what's going to do poorly. Then I would look at the stock charts to validate my opinion. That's the way that I go about it. People who blindly follow just the tape, none of those people make a lot of money. And what I found is the really good investors, I think, invest more off of situations in the market and they follow cycles. A lot of them do. And you can use technical analysis to basically validate your opinion on a cycle or something like that. JSC says no material change in WTI fair value this week, remains a few bucks undervalued. So that's for WTI oil price. So we're just a little bit undervalued, but for the most part in a pretty fairly valued market, at least against commercial inventory levels. Real estate XLRE is in the process of completing a reversal pattern. Will it make it? Yeah, I think it will with time. I think what it's doing is it's pricing in lower interest rates. And I think the market is doing that across the board. It's trying to price in lower rates. But in the short term, looks like we're getting some selling pressure across the board too. We have two opposing forces being applied to XLRE and a lot of these other sectors, and we'll see which one wins. Richard Bernstein Advisors, this is stop with the Sahm rule and big emergency rate cuts. Unemployment is a lagging indicator, and the Sahm rule hits when the economy is already in recession. But GDP is currently tracking at 2.5%, 3%. Now, the only problem I have with GDP is they understate inflation. And if you understate inflation, of course, your GDP is going to be overstated. So, what's the real rate of GDP? And that's where I get a little bit, It's like if we're double the inflation rate and they're just lying about it, well, then we don't have any growth. Or maybe we're negative. Tough to say. Unemployment is ticking up. Says that said, residential building construction, which is usually in contraction well before a recession hits, just hit a new cycle high. And the residential building construction, that's something that you really want to watch. And employees from that sector do drive recessions because that means you're having a slowdown in the real estate market. And the real estate market is your credit expansion from the monetary side. So this is looking good from this data. And the unemployment, I think, is coming from over in the tech sector. We're seeing a lot of unemployment and cutbacks in tech and some other sectors as well, but not from construction real estate. The recession fears based on the Sahm rule could be questioned. So we've got this chart here. It says recession indicators before triggering of Sahm rule average change over 4 months. So you can see in 90, 2001, and 2008, they were all negative. They were all contracting. 2024, for non-farm payrolls, real personal income, including transfers and industrial production, are all positive. Wait, I thought we were in contraction. How could these all be positive? Well, this is more information saying that this data doesn't match some of the earlier recessions that we've seen. And the data is a little bit different. Just an FYI. This is concerning. The U.S. unemployment rate has risen for 4 consecutive months, the longest streak since 2008 financial crisis. Over the last 75 years, every time unemployment rose for 4 consecutive months, the U.S. economy entered recession. The jobless rate has surged from 3.8 in March to 4.3 in July, its highest level since October 21. Meanwhile, the U.S. hires rate declined to 3.4% in July, its lowest level since the 2020 pandemic and below the pre-pandemic average of 3.8%. The U.S. labor market is contracting. So recessions, number of consecutive months increases in unemployment rate. You can see there that we are contracting. Well, that's in stark contrast with the information that we just got here of non-farm payrolls, real personal income, and industrial production. That's weird. But there is unemployment going up. Christine Guerrero, she says, I like big draws and I cannot lie. Okay, I put that I cannot lie in there. But we got 3.7 million in crude oil draw for 8-2. Domestic production, 13.4 million barrels per day. Cushing and gasoline up a little bit. And distillates up just a little bit. Kind of a wash there for the most part. Jordan, he says, if we're going into recession, it's not the time to own base metals. It's always tricky as far as when silver will perform more like copper or gold. Days ago, silver broke out to 3-year high versus copper. Silver versus copper in a solid uptrend. So silver's outperforming copper, and I think that will continue. And we need silver to act like a precious metal. It needs to grow up and act like a precious metal, not a base metal. But I do think with the market conditions where we're at, it could be impacted in the short term if there is further slowdown. Even gold, and if there's a sell everything liquidity type problem, yeah, it's going to sell off. But usually when the rates go down, it's going to front run the liquidity that comes from it. So I think we're going to go higher. We're going to go higher in the medium term. And that's what we've got for today, guys. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. We still have that May Day coupon if you're interested. We've got a Sunday question and answer session coming up this weekend at 5 p.m. And that's all I've got for you guys. So we'll catch you next time. This is Finding Value.